Welcome back. You made it to episode 2 of Financial Literacy 101. After our first episode, I hope we've convinced you to save. More than that, I hope we've talked you into investing. I'm Savanna Taylor, and today we're talking stocks, bonds, and diversifying through mutual funds. Did I lose you? I know what you're thinking. Only rich people buy stocks. And bonds, what are those? Mutual funds? Is that like a pyramid scheme? Take a deep breath, because we're starting with the basics. Let's start with bonds. Imagine yourself going to the bank to get a loan. The bank gives you a handful of money. Over the next 5 or 10 years, you've got to pay that back plus interest. When we talk about bonds, you are the bank. You buy a bond, which gives a company money. Over the time you own the bond, they pay you little bits of interest and maybe some of the original money you lent them. At the end of the bond, after 20 or 30 years, you get your money back. Stocks are different. When you buy a stock, you own a part of a company called a share, but it's a tiny little piece. For example, Amazon and Google both have 500 million shares. When these shares started their lives, they were sold by the company for cash. Buying a stock after that, it's a private sale, like buying a DVD from a friend. Your friend is the only one that makes money, not Star Wars. And your friend is the one who sets the price. They could ask $100 for a 30-year-old VHS. Stocks are like used DVDs. The prices aren't written in stone. They can go up and down day to day depending on how bad you want to buy or how desperate someone is to sell. One of the basic ideas of finance is risk and reward. If you want to make money, you're going to take on some risk. Bonds and stocks are both opportunities to score reward. That means there's a risk involved. With bonds, that risk is low. Companies don't just stop paying their bills. That's little to no risk. Unfortunately, that means your reward will be smaller. But a lot of people like bonds. Here's a quick explanation of why with Paul Merriman, WWU alumni.
So people who are very, very conservative can own something that doesn't go up and down. They don't have to worry like, oh my God, everything's going to go down. I'm going to go broke. They don't have to live that kind of fear. On the other hand, one of the most important things that I remind myself and for years have reminded others, never take a risk for which there is not an expected premium.
What about stocks, Paul? How risky is owning a part of a company?
Stocks never had a 40-year period that they didn't make more than inflation. Remember, the worst 40-year period was a compound rate of return of 8. In other words, it's a great place to put money for the long term. I'm talking about stocks, not bonds.
So it sounds like we've got to make a choice. High risk, high reward stocks, or lower risk, lower reward bonds.
So there is a right way to do it, but when you come to that fork in the road, that choice between stocks and bonds, open up your heart and open up your brain and take a look at the reward that comes with taking the risk of equities for the long term.
Wait, why not both? Let's think about it. Put half your money into bonds, the other half into stock. In a given year, a bond could increase in value 5% and a stock could do 15%. Now you made 10% on your money. You stayed a little risky with the stock, but insured yourself with the safety of bonds. And it doesn't have to stop at one company's stock and one bond. You could buy 100 different stocks and 100 different bonds. That's diversification, the fancy name for not putting all your eggs in one basket.
Diversification is considered to be the only free lunch on Wall Street or in the investment community. And what is so wonderful is the more companies that you have in your portfolio, and this is so counterintuitive, the higher the expected return. So what does that mean to us as investors? That we don't want to own one company. Not when we're expected to make more money, when we have great diversification and therefore less risk.
Are you thinking what I'm thinking? Let's Google some hot stocks. Buy a share in every company, then start trading? Read the Wall Street Journal, watch CNBC, and be your own broker? Slow down, partner. Playing Wall Street is risky. I know I said risk means reward, but it's not guaranteed. Listen to Paul about Wall Street.
Wall Street, in a way, they encourage you to speculate. Because I was on Wall Street for a couple of years, many, many decades ago, I had a chance to get a sense of that environment. And when you're in the middle of that environment, it almost seems like you're so close to it that surely, if you can find good companies to invest in, that you ought to do okay for your clients.
What does that mean? It means that when you're in the action, when you're reading the news every day, you're making big decisions on gut impulses. If you read that Facebook's earnings are down, you want to sell your Facebook shares. Maybe Amazon has a great quarter. Now you want to double down and buy more. But really, you're risking a lot for short-term gains. What are we after? Long-term sustainable earnings. So let's step back, put our emotions aside, and let someone else take the reins. The most responsible way to do this is with a product called mutual funds. It's exactly what I described earlier, buying high-performing stocks from great companies. But it's not just your $100. It's you and hundreds of thousands of other investors in the market. You're all pooling your money to buy hundreds and thousands of shares.
And with a lousy $100, just $100, you can actually invest and have over 1,000 stocks in your portfolio. It's the magic of mutual funds. And you have complete liquidity. You decide you want to take out some of that money that's in that account. You can get that money on a daily basis during the week when the market is open. At the close of the day in the stock market, they will then liquidate. If you want to take out $50, you can take it out.
Mutual funds sound great, don't they? But don't just believe me. Use websites like Morningstar.com to check their reputation. Look at their track record. Mutual funds put money into your pocket.
Mutual funds, you can absolutely look at a track record. You can see it virtually daily if you wish to. But Morningstar.com, this wonderful, rich source of advice, and not only advice, but data on mutual fund performance. You can see it for the last year, 5, 10, 15, and more.
So we threw a lot at you today. Let's review. Stocks or shares are owning part of a company. That can be risky. Buying a bond is letting someone borrow your money, and it's typically less risky. To get the most out of your savings, you should invest in a little bit of both. But don't just buy stock or lend to one company. Invest in mutual funds. They pool your money with a bunch of other people's cash and invest in thousands of different companies. Oh man, why didn't I just start with that? I'm Savanna Taylor, and this has been Financial Literacy 101. See you next time.